on panel, a regular weekly slot goes out every Tuesday at 11 a.m. where we just sort of talk about a specific topic relevant to small businesses with a panel of experts that I have assembled here today. So before we sort of crack on and have a little discussion, just go around the room and you can introduce yourselves, let people know who you are and what you do. Wendy, do you want to go first?
Hi, I'm Wendy from Paying Hmrc. We're a multi-award winning outsourced accounts department, in essence, for our clients, helping them zero in on the numbers in their business.
Thank you very much. And Stephen.
Good morning, everybody. My name's Stephen Mather. I'm a solicitor. I help small and medium-sized businesses with a wide range of legal problems.
And last but not least, James.
Yeah, thank you, Paul. Good morning, everyone. My name is James Blacklaws, and I run a commercial finance brokerage called JB Commercial Finance. And I've been in the commercial banking / finance industry for around about 20 long, grueling years.
You must have started when you were a boy, James.
I started at school.
Okay, so the topic for today are what are the financial mistakes you think businesses make? So you're, I guess, 2 out of 3 of you are in the finance world. I'm sure you all work with small business. You've probably all come across issues that they face. So yeah, why don't we just explore and see what you guys think those mistakes are and maybe some of the solutions to those mistakes. Should we start with you, James?
Oh, look at that. I think with regard to financial mistakes businesses make, it very much depends where you are on your, for want of a better term, business cycle or business journey, because the sort of mistakes you make as a startup are pretty things like undercapitalization, no contingency, no plan B, etc., or not having your terms and conditions in place to send to customers. They're all mistakes which ultimately are financial. While as you get bigger, the mistakes become different, albeit they can be quite similar. So with regard to offering credit terms to clients, with regard to issues about taking on members of staff, do you involve experts like Wendy when you look at your payroll? Do you involve experts like Stephen when you're looking at taking on bigger clients and looking at terms and conditions? So I think there's an awful lot to explore in this, but ultimately it comes down to one word really, and that's cash flow. As far as financial mistakes, it all impacts on the cash flow of the business, whether you haven't got enough cash to get up and running or you've not got enough cash to continue to survive or grow. So I think there's a lot to explore, but certainly in my experience, I deal with established businesses mainly. And the biggest issues I have are having to arrange for them to talk to someone like Stephen and say, you're owed money, you know, what are your terms and conditions? What are you going to do about it? Why are you continuing to work for that particular client when he owes you this much money? It's 150 days overdue or whatever. And I think that kind of that naivety and maybe putting a bit too much personal relationship on thing is one of the larger financial mistakes that businesses make.
Okay, thank you very much, Stephen. What about you?
Yeah, so I'm one that doesn't directly work in the finance industry, but obviously clients come to me when they have problems to sort, and there's a knock-on effect, and usually problems means money. That's it. No one ever comes, because someone slightly upset me. It's because it's had an impact on it. I think James is right. Always agree with James is what I say in life, because if you don't, he'll call you all the names under the sun. So always best to agree with him.
For the sake of legality, that's not strictly true.
So look, the first point that he made was it depends on where the business is in its life cycle. I've written down 10 points that came to mind as to mistakes that small businesses make. And the first one that I've noted here is actually not setting up in the correct structure. So look, there's a choice of different business structures. Most people, when they start up, they might just be a sole trader, just them kind of doing it on their own. They may not, surprise to Hmrc, they may not even register as being self-employed at that stage, just kind of running it through their personal account, and trying to make a little bit of money on the side hustle, as it's called these days, and everybody wants a side hustle on the internet. But for me, that's even at that point, a business, somebody that is looking at being in business should be really seriously looking at what structure they should be setting up as. If it is a sole trader, then great, but then it should be registered. They should have separate bank account. They should be running it as a business. But depending on how quickly they anticipate what their revenues are going to look like, how quickly they anticipate to get to a certain level, they should be taking advice from someone like Wendy as to whether or not they should be incorporating, or at what stage they should be incorporating, because there's some advantages of doing that, both legal and tax. And that for me is the very much of a starting point. Linked to that, my number 2 is not taking advice. And I've seen so many businesses, particularly small businesses, understandably, because like I know when I started businesses recently and in the past, money is key. Actually that working capital is key, and going to an accountant or a lawyer and spending a few £100 and getting some advice is a tough one to spend. But it's essential that at some point, that small businesses take advice, and that first step, what the structure is a really good one to start on.
Okay. Wendy, what are your thoughts? What do you come across when you're working with clients, and what solutions would you put forward to some of these issues small businesses face?
Absolutely agree with Stephen on the sole trader side of things. I worked with a sole trader many years ago who gave me 11 months worth of paperwork, and was very surprised when I told him he hadn't made any money. In fact, he'd made a loss, because he'd been putting it all through the joint account, and because his wife's earnings were also going into said joint account, it masked the fact that he was making a loss on his business. So definitely you need separate bank accounts from the off. You need to register with HMRC whether you're self-employed or not. And the other thing I would say is debtor days. I came across another business who gave their customers 45 days. They were really generous, gave their customers 45 days to pay their invoices, but they were given from their suppliers only 30 days. And they wondered why their money was running out, because they were paying out the money before they'd had the money in. So look at your debtor days and your creditor days, and make sure that you're getting the money in before you need to pay your suppliers. I think that is a really big one.
Yeah, I think that's always a thing that I see is around invoicing and setting the number of days. As far as I know, Steve, there's no legal reason for setting 30 days or 45 days. In fact, I think you could just sort of say payment on demand when you present the invoice. So it's not like anybody is stuck to these terms. Yeah. It's almost like they're made up by people just because they think they have to give people 30 days.
Absolutely. Look, so important that it made number 6, 7, and 8 in my list of 10.
Wow, we scored a hat trick there.
Yeah. So number 6 in my list was having good terms and conditions. There's a good starting point. Terms and conditions being, a contract, an agreement between the two parties, setting out a variety of different things that are agreed. But one of them is payment terms, and making sure that right from the off we know when we're expecting to be paid. And you're right, Paul, that there's no legal minimum or maximum. Some of the bigger companies, they're still trying to push clients to go to 90 days after the day, after the first month the invoice was raised, provided the invoice was raised on yellow paper on a Wednesday, then we might pay you. And there's a lot of companies that still kind of do those tricks, and I would advise clients to stay away from that type of work. But generally speaking, it is having some good terms and conditions in place. But that's just the starting point, because if you've got terms and conditions that say, look, invoice is due on demand, on receipt, or 7 days terms or whatever, that is only the starting point, because you've got to follow that up with an effective debt control system. If a small business is using something like Sage, Xero, QuickBooks, and that kind of thing to do its invoicing, fully recommended, and I know Wendy will kind of support that, fully recommended that they do that, but it will have built-in debt collection processes. So you raise an invoice, you can then go remind this person on 7 days, 14 days, 21 days. If you're doing it manually and you're still sending out, doing an invoice manually, you've got to make sure that you are chasing that up for payment. And what I would suggest to a client, and what I did when I put in a debt control, debt collection system for for massive organizations, actually. One that I put in many years ago was for a company called T-Systems, which is the parent company of T-Mobile, and they didn't have any credit controls in place. We put in place a system where invoices would go out, and then we would then email them within a few days and say to the credit controller, just making sure you got the invoice. First step. Really important, because lots of people sadly go, oh, I never got the invoice when they're first chased, and then think that their 30 days starts from when they told you they got the invoice.
Yeah.
No, it doesn't. It starts from when I sent the invoice. So it's always worth checking to make sure that someone got the invoice, and then goes, make sure everything's all right, no issues with it. Yeah, that's fine. We'll get it sorted. And then you're following it up. If it's 7/14/21, then you are chasing it up, and it's, as I say, good to have that as a system. And number 8 on the list, combined with all of that, is, from my perspective, is don't give credit. Yeah. Don't give credit, particularly if you're a small business, because James is absolutely right. Cash flow is pretty much the most important factor, and that's the overarching thing in a small business is cash flow. And giving credit to organizations can just lead to massive problems. Like when you were saying, you're giving credit where your customers are paying on 90 days and you've got to pay your suppliers in 30 days is going to really bind up your working capital. And so, yeah, my suggestion and advice to clients is always, what can we do here to reduce the amount of credit you're giving? So I was just doing some terms and conditions for a bespoke kitchen designer and manufacturer, and they have people coming in, and they were going through the whole design phase, getting it all manufactured, and then saying the invoice is due, which could be £20,000-30,000. Invoice is due just before delivery. And they were like, we're covered here because that's great. Okay, what happens if someone pulls out beforehand and you've done the design work and the manufacturing, and then somebody turns around and says, yeah, no, we can't afford it anymore? Wouldn't it be better to turn around to them and say, look, let's have some stage deposits here so that we're covered? So on the design phase, and they said, well, it's a free design. It is free. Well, let's change that then. There's a cost attached to it. Yes, it's free if you end up buying the kitchen, it's included in the price. But what you don't want to do is just be giving out free design services to everybody, and then they go and buy a kitchen somewhere else. So let's actually stage that and say, look, okay, here's the payment. If you're happy with the design, so you've got to pay this much here, you've got to pay this much on build. And so we built that all into their terms and conditions, and that's going to massively improve their cash flow. So yeah, all of that is all aimed at cash flow, terms, conditions, debt collection, and not giving credit.
I think it's a really valid point about it just being the start, isn't it? Because I'll see customers, and one of the things I ask for as part of a lending request sometimes is an age, debtor, and creditor list. So for those who don't know, that basically is all the money you're owed and all the money you owe people. And yes, the sort of scenario that's painted earlier where you're getting paid in 45 days and you pay in 30 days, that in itself is a problem and leaves a cash flow gap. But it gets even worse if you're a conscientious business client and you pay all your invoices in 30 days and people stretch those 45 days. They stretch it to 60, to 65, to 70 days, which unfortunately is incredibly common, which, ultimately keeps me and Stephen in a job sometimes. So we're not complaining too much. But that's a lot of the time I see that. If everything worked fine, it would be great. You can have your terms and conditions in place. You can have the days, the debtor days, all of that stuff lined up nicely. But then you bring in the human element, which is actually you may offer 45 days, but they're paying you in 60, and you're continuing to work for them as well. And they know this, and they're worried that actually, if I stop working for them, they won't pay me that money you're owed, and you end up in a massive downward spiral of debt. And I see it very, very often. And
classic scenario of where you've got a main contractor and a subcontractor, and the main contractor goes, the subcontractor's owed some money. I'm owed 50,000. The main contractor says, we need you to carry on doing the work, and the contractor says, I'm not falling for that. I want money. And the main contractor says, well, look, we're able to give you 10 grand now, yeah, but we need you to carry on doing the work because the customers, shouting at us and need to do this and that. And people go, oh, okay, well, I'll take the 10 grand because at least I've got something, and then go and do another £20,000 worth of work. Yep. And so they end up in more debt, giving more credit.
I mean, taking a step back from what you guys have said, around the invoices and the payment terms, sometimes it's first of all, there's a couple of things. First of all, it's them sending out the invoice. You know, if you leave it till the end of the month, then not only have you got your 30 days, you might have built 60 days in because you've done a job at the beginning of the month. So I think, you know, there's no reason why you can't send an invoice out every day if you've done the work, etc., etc. I think that I have experienced that. So, you know, I'm involved in a members club in Northampton. We've got 5 grand worth of carpet that was fitted last year that we've never been invoiced for. So, you know, that some business somewhere, you know, is owed 5 grand. And they just, I don't know, they're probably oblivious to it now. It's a job gone. They probably thought they'd invoiced it. They probably thought they got paid. But, you know, this is where we get now. It must be for sort of nearly 7 or 8 months that they haven't raised an invoice yet. And I think we've even chased them. You know, we've even said, you know, can you raise an invoice so we can pay for the carpet? And they still haven't done it. So, you know, it's just crazy, really. But there you go. It is what it is.
I had a client like that who was basically on the road most of the day. So they were an IT consultant. So they were going from site to site fixing people's computers. By the end of the day, they forgot who they'd been to see. And there were so many invoices that weren't raised. So I got him in the habit of, when he got back in the car, using the Xero app, raise that invoice before you switch the engine on, raise that invoice, and then they've got it immediately. And they also then haven't got the chance to forget about what you've just done for them, because you've literally just left their building. So it's raising the invoices in a timely manner is huge. It's a huge thing. And clients don't.
I think that's a brilliant tip. I had a guy come and do some work here, and then says, "Oh, I'll just do the invoice now," and sends it, and then says, "Just make sure you received it, just because sometimes there's a bit of a, you know, it can get stuck in your spam." So he's done the invoice, goes, "Yeah, is that all right? Yeah," click send, and then says, "Have you got that? Does that come through?" And actually, it was really well done, because it didn't feel like, you know, as a lawyer, it didn't feel like him doing the things that I tell people to do. It felt just like this is a normal conversation, just like, yeah, sort the invoice out. And if you're, you know, if you're kind of doing that with anybody, sounds like a brilliant idea. And what's the cost of that software? It's like, you know, outside of a trial, it's 20 quid a month, isn't it, or something like that? So
there's
really good value to have.
It is great value. There's another little tip on the invoicing side of things. Sorry, I've just seen an item that's come up on the chat. There's another piece of advice on Xero, is that if you send the invoice and you send a PDF, or you have an option to see that it's been sent, if you don't send a PDF and force your client to actually click on a link to see the invoice, you'll see when they've viewed it. So you're able to see, it comes up that they have viewed that, so they can't sort of basically, "Oh no, we didn't receive it." Well, I can see that you opened it on this date.
Yeah, I mean, there's lots of technology out there that helps small businesses, you know, be better at what they do, and I think, you know, businesses are getting better at it. I think, you know, they get more technological aware and have these apps, etc., etc. Is there anything else that you commonly see inside of businesses that are regular mistakes that you're coming across, or any advice that you give businesses that you put stuff in place to help them?
One is check your direct debits. That is massive. And I came across a client who wanted some help with their Xero. They've been using Xero for over a year. And the first thing I do is just do a little quick audit of all the direct debits that they click OK on every month, because they know it's come out of the bank, so they don't actually check it. They've been paying £300 a month to Sage for over a year after they'd stopped using the software.
Ow.
It's an interesting point, and it's something that happens on the personal side, moving slightly away from business.
Yeah.
You especially see it with regard to things like insurances.
Yeah.
I mean, the amount of times I've sat down with clients and said, look at their bank statements. Who's that payment of £40 to Standard Life? Don't know, some sort of insurance. And you're like, you've got 5 payments here for different insurance companies. I'm pretty sure there's a bit of duplication here. And all of a sudden, people can wipe £200-300 a month off their expenditure. Exactly. And on business here, it's always the last thing you check, isn't it?
It is. And say this basically paid for my fee for a year. telling them to cancel that, because that was an awful lot of money that they've been paying out every single month. And it's all those little softwares that you sign up to on a monthly direct debit that you have every intention of using. Some you will, like Canva or things like that. They're not huge amounts of money, but if you stop using these softwares, cancel the direct debits, because you'll be surprised how many people are just letting those go through every month, and it's costing their businesses an awful lot of money that it needn't do.
It's like the business version of the gym, isn't it? You
Exactly
thinking,
that.
One day I'll start using Canva again, or go to the gym again. Never.
Well, cancel the subscription and sign back up when you do start using it. Don't keep paying for software and things and direct debits that you're not using.
It's easily done. All these things that take your card details, even for your free trial, then you just forget to cancel it.
Exactly.
So you leave it going, and then because it's not a big amount, you just sometimes miss it, don't you, on the radar? But they add up, the tens of pounds add up to hundreds, etc., etc. So it's quite scary. So James, you're a money lender or a broker for finding funding for people. What are some of the mistakes that businesses make there? Not necessarily why they want the funding, but when they apply for funding and get rejected, or what sort of things are going on there with businesses?
Well, there's a number of reasons why businesses get rejected, which is probably another conversation in itself. But I think when applying for finance, other mistakes are made. Sometimes customers don't borrow enough because they underestimate the costs of moving premises or the costs involved in taking on a new contract. But the other thing, which I think is we're going to see an awful lot of a lot of literature about over the next year or two, is interest rate management. So we're going to see people on the personal side with this with regard to mortgages, etc. But on the business side, if you take out a commercial loan, whether it's a commercial mortgage or whether it's a cash flow loan or a working capital loan, I mean, I don't know the exact figures, but I would say 9 out of 10 of them are variable rate linked loans. So we've had an increase last month in the Bank of England base rate, or it was last month. We anticipate another one coming up very shortly. And I read, this is the exciting life I have. I read an article over the weekend predicting that base rate could be 2.25% by the end of this year. So if you've got £100,000 commercial mortgage and it's on a variable rate loan, that's going to cost you £1.25,000 extra purely in interest going into next year. And I think people make the mistake of not projecting that, not budgeting for that, and not thinking it's going to happen. It's a head in the sand job. So while there's a million different ways, different reasons why people are declined, whether it's bad credit, whether it's loss-making business, insolvent business, poor credit history for the business, poor credit control, all those factors can be reasons why you're declined for a loan. Actually, once you've got a loan as well, once you're actually applying for a loan, you're going to be successful. There's steps to take as well to make sure that you're getting the right product in place. And that's what guys like me try and help you with. But ultimately, whether you decide to fix your interest rate, how much you borrow, the term you borrow it over, people want to pay their debt back too quickly. So they want to pay it back in 5 years as opposed to 10 years, when actually they could stretch the term to help their cash flow and plan for contingencies. They don't always do that. And I think being over optimistic can be a real problem when it comes to dealing with the finances of your business.
I think you're right. Anything else on your list, Stephen, we haven't covered yet?
Absolutely. So yeah, number 3 was not putting in place a shareholders agreement. So I see so many times people going in business with somebody, a mate, usually, or a previous colleague, etc., and they decide that they're going to set up in business together, and which is great. That's absolutely fantastic. I love people setting up in business, but again, it's all about making sure that they've got the everything lined up at the start. And a shareholders agreement. So what a shareholders agreement does, it's an agreement between the two shareholders about certain things in running the company, what they can and can't do. And where you've got 2 or more people involved in running a business, usually everything's hunky-dory. They're mates, they know each other, they respect each other, they get on really well, all of these kind of things. But I've seen it so many times from the other side where they fall out, where they no longer get on, or one person wants out of the business, or they're doing things that they shouldn't be doing, and the other person's going, well, what can we do to stop them, etc. So a shareholders agreement regulates a number of different things, and this isn't the forum for telling people what shareholders agreement is. I've got some videos on my YouTube channel about what they are if people want to have a look at them, or they can speak to me. But the long and short of it is they're like it's like a rule book for a company and its shareholders as to what they can and can't do, and what happens if there's a dispute, or what happens if there's a falling out, or what happens if one person wants to sell their shares. And the most important for me, the most important reason to have a shareholders agreement, it's linked to the next one on my list, which is what happens on death, dealing with the estate. And it's a massive financial consequence, and something that lots of people put off. We know that people put off getting a will, and the key point is this: in a shareholders agreement, we can determine what happens to somebody's shares when they die, right? And that kicks in before a will kicks in. So within the shareholders agreement, there's only real two options. Somebody wants their shares to be inherited by their estate, or somebody wants their shares to go to their other shareholders. And the key thing to distinguish is this: if the shares get inherited by the estate, it means their estate, their widow, their family, their kids, their auntie and uncle, if they've not got kids, whatever it might be, has to then deal with the shares, and they get their dividends. And sometimes those people don't do any work, and so you've got, I've got a company at the moment, set up by brothers, and now it's their sons that are running the business. And one of them died, and one of the sons now has some shares, not working in the business, but gets to draw a dividend. That really grates on people. People don't like that, because in a small business, they want you to work for your money. And so really important to make sure that you've got that. And what happens on death, what usually people tell me, is that they would prefer their estate to have a lump sum of money, okay? Rather than their shares, rather than having to deal with their shares, it would be good if they had a lump sum of money. And there's some inheritance tax planning around that as well. But what's really important is linked to having a shareholders agreement is putting in place some insurance, so that what usually happens then, someone dies, the company then has some insurance to be able to buy those shares, or the other shareholder has some insurance to be able to buy those shares, meaning that your estate, your deceased, the people that you're leaving behind, have money, have a lump sum of money, and sort this out. And we're talking about companies, not just small companies, it's companies that are maybe worth £1 million or £5 million, and they don't sort it out. And then what happens is they leave their loved ones behind, their wife or their husband left behind, and they've got some shares, and now they have to sort that out. And it's a horrible process. And it would be much better if the person that was left behind had £1 million, and it was all covered and paid for by the company, and it was all inheritance tax free. And a much better way of doing it, bearing in mind inheritance tax is 40%. If you die without putting one of these things in place, without getting insurance in place, if you die, HMRC want a valuation of the company. The solicitors doing the probate, or you doing the probate, will go, well, the business is worth £1 million. My shares, I've got half of them. It's £500,000. I have to pay tax at 40%. So it's £200,000. What is it? Come on, mental maths. £200,000 that you have to pay to the taxman for what? Nothing. Yeah, much better, and a massive financial problem, but much better if the person died, the company or the other shareholder had £1 million and said, here you go, widow, grieving person, here's £1 million. Thanks very much. No tax to pay on that. And away you go. So it's a massive mistake that people make, something that no one ever really thinks through, because we never like to talk about death, never like to talk about what happens. But it's just a way in which pretty much any small business with more than one shareholder can deal with for very limited costs, and make sure that they're also providing for their family and it's being paid for out of the business.
Thanks for cheering us up about death, Stephen. Much appreciated.
That's heavy.
Can I chip in on something else with friends that start businesses? And this is one that I came across personally with a client of mine. So I was doing the books for this client. He went into partnership with somebody else, and there's somebody else that, oh no, we don't need her, definitely don't need her, I can do the bookkeeping. That's fine. But this person that was so adamant they wanted to do the bookkeeping were being a little dishonest with the company money, shall we say. So when I was asked to review it 9 months later, when things were starting to get a little bit between the two people, the first thing I looked at was why the general expenses in such a small business were over £10,000. And when I actually looked into these general expenses, the person that wanted me as far away from the bookkeeping as possible was paying his mortgage, his gym membership, and various other personal expenses through the business that the very trusting other partner didn't realise he was doing. So, you know, look at stuff like that as well. You know, mates can be mates, but they, you know, that just make sure that somebody's looking at stuff for you.
Yeah, I've seen it before. There was a company I dealt with many years ago that had 2 sets of books because the MD was siphoning off, you know, 6-figure sums each year, and the FD was in on it. So yeah, when they're presenting the accounts, you know, they had regular management meetings. There was a false set of accounts being presented because it wasn't the true representative of the company, because the MD was siphoning off quite a healthy sum for himself, which, you know, can happen. But on that subject anyway, management accounts, do you guys see small businesses having, you know, monthly figures rather than waiting to the end of the year to find out whether they've made a profit or loss?
I think, I mean, my point of view, and Wendy's the expert on this, but it's something which, putting my broker, my lender hat on, is increasingly important, especially over the last couple of years with the erratic businesses' performances during lockdown. And it used to be, if I go back 10 years, if you were applying for finance for a client, generally speaking, unless it was an incredibly substantial amount, sort of late 6, early 7 figures, you would take the last set of books and that would be it. And you'd look at the bank statements and that would give you a picture. Now, increasingly so, lenders want management information, which is, if not up to date, then certainly only end of last month. And I think from my point of view, there's no real excuse if you're a business at a certain level not to be able to produce that, because you've got people like Wendy who are experts at doing it. And Wendy's job, correct me if I'm wrong here, Wendy, is a lot easier because of the likes of Xero, Sage, etc. Because it's not that hard to put together and just draw off. Doesn't mean it's not a battle to get it out of a customer sometimes, but it's something which I certainly would advise pretty much any business who are to have a damn good understanding of where they are at the end of the month. If for nothing else, then for corporation tax planning, to be perfectly honest, but more importantly, to see if they're actually making some money.
Yeah, exactly. Neil Watham's just made a comment, which is exactly why you should have the accounts, is you know, so you can review it against your budget and also against the you know, financial measurements in your business. But you know, a lot of people don't do that. You know, Steve, were you going to say something on that topic?
I actually, something on the slight topic before, but it kind of links in with the two, which is making sure. So what tends to happen is directors of businesses think that they can kind of do whatever they want, and if the business then fails because of some bad management, they're in a limited liability company and they get to walk away and it's all right. But actually, it's far from the truth. And so we always, as lawyers, we always recommend and suggest that people have limited liability, so that you know, suppliers, and the point of that is so a supplier or customer can't sue you for £1 million and then go behind the company and go directly to the shareholders. But what can happen if a company goes bust, goes under, what can and very much does happen is that an insolvency practitioner is appointed either by the government or by a creditor to investigate the affairs of the company, and then they can, in certain circumstances, attach personal liability to the directors. And so there's a couple of things that I've seen, and it's now occurring very commonly. There's an insolvency practitioner in Leicester that took a case to court and won it, and it was on the failure to register for VAT. Okay, so the business failed to register for VAT. Happens more often than you'd think, actually. They failed to register for VAT because they've not done their management accounts. They don't know where the figures are. And then by the year end, the accountant goes, you've hit the threshold for VAT. We better register. And we've got to post date that as well. And then all of a sudden, that £100,000 or whatever that they've earned, 20% of that should have been accounted to VAT. And we've also all of a sudden got a liability. Now, I saw one recently where the accountant then went, oh, well, that's a big liability. What we might want to do is close the company and start again. And that was a terrible,
Have another go.
idea. Yeah, terrible idea. But they went with it and closed the company. And then the insolvency practitioner just pops along and says, well, that was a breach of your director's duties. You should have registered for VAT. As a result of that breach of director's duties, there's a loss to the company. And we're going to recover that loss from you, Mr. Director. And that kind of thing happens more often than not. So not paying HMRC sounds like, companies do it all the time, and they go, oh, we can just liquidate and close the company. But there's a real risk that you get chased personally. And things like, James has been banging the drum on it for the last 2 years. But things like, the business bounce back loans and the COVID loans that came out, where people were told, there's no personal guarantee attached to this. Brilliant. Let's just borrow loads of money and then, go and buy a car and close the company. Yeah, well, look, you're going to get stung for that, right? So there's a couple of options where they get stung. One will be fraud and some criminal charges, but definitely without doubt, and we're seeing it come through the system now, as the insolvency service are pursuing claims against directors because it was in breach of their director's duties. And so all of a sudden, the director's thinking he's got 25 or 50 grand out of the government. The company's, then gone bust. It's not going to happen. So yeah, the final point of my list is not complying with your director's duties. And they are quite wide and varied. Some of them are written in law, some of them not, some of them the Companies Act. But it's really important to make sure as a director you are running the business to the best of your ability, having full information and knowledge about what's going on. There's another what happens a lot, and I've seen this, where a company goes bust and they have massive directors' loan accounts. Directors' loan accounts, for people that are watching might not be familiar with it, is where businesses are basically paying too much money to to the directors and shareholders because they don't really have enough profit at the end of it to declare a dividend. So they've not done well, but they've still taken money out, and the accountants go, well, allocate that to the director's loan account because you'll pay that back, won't you? And the directors go, yeah, of course, we'll pay that back, because if you don't, there's going to be some tax to pay. Yeah, we'll pay that back. And then what happens is the business goes under. And again, insolvency practitioners will come along and they will absolutely love a overdrawn director's loan account because they are the easiest ones to bring. We just write to the directors and say, oh, your director's loan account sits at £56,000, and if you don't pay it within 7 days, we're going to come after your house. And people don't realise that there's some personal liability attached to running a business, because it's really easy. See limited liability and think that's it. I can run away, I can walk off without any responsibility or liability, but it isn't the case. And so the final point is you've got to comply with your director's duties and run the business properly.
Yeah, if I can just say one thing relating a couple of points you made there, Stephen, about the bounce back loan or any of the government loan schemes, but we'll talk about the bounce back loans. That's the most prevalent one, and overdrawn directors' loan accounts. I follow quite a few Facebook groups, and certainly the smaller end of the SME marketplace, whether they're freelancers or one-man bands, let's just say turning over up to £100,000, an awful lot of that is coming out in the wash now, where a director has taken out, or a business has taken out a bounce-back loan of, let's just say, £30,000, and have used it to pay dividends to the director. Now, if you use it for a monthly salary, that's okay, as long as it's an official salary. It's a running cost to the business. But if you're taking out a couple of grand a month in dividend, and that's coming straight from the bounce back loan funds, which is leaving the company overdrawn and insolvent, then when that's getting wound up, as you say, the IP is rubbing his hands saying, this is easy. This is a straightforward job. You have made my life easy because you are taking out money which isn't yours from the business. You are not, fulfilling your fiduciary duty, sort of limited company as a director. And I think we've only seen the start of that. So it's another reason why you need to get on top of your management information, because then you identify this kind of issue happening and you can rectify it. Because you mentioned tax on this as well. And I can't remember what it is. Is it 40% tax or 30-something% tax on an overdrawn director's loan account? It's a very high penalty to pay if you don't repay your director's loan account within, is it 9 months or whatever it is?
9 months. 9 months from the year end.
Yeah. So
the other thing, one thing I've mentioned about the VAT registration thing that Stephen was mentioning, that's done on a rolling 12 months. So don't get to your year end and look at your actual year at your year end. You need to be, if you're getting close to that threshold, you need to be looking at your accounts every month on a rolling 12 months, because it rolls back over 12 months, not from financial year to financial year. So especially if you have a business that's seasonal and you have a really high amount of income for part of the year and then it tailors off, you must look at a whole 12-month period when deciding whether you've hit that threshold or not, which is currently 85,000.
Good point.
Excellent. Well, I think we'll wrap it up there. I'm conscious of time. We don't want to be here all day. I'm sure you've got other stuff to do. I think we've successfully scared the SH1T out of anybody that might be listening or watching this. Certainly anybody thinking of starting a business we probably would have put them off by now. But I think it's it is safe to say you do need to look at your obligations, be they financial or otherwise, inside of any business, and there's help around for you to sort of keep you on the straight and narrow, as it were. So thanks, guys, for joining me today on this session. As I said earlier, these are regular sessions going out each week at 11 a.m. on a Tuesday. Next week, we've got a sales and marketing theme, and we're actually going to be talking about authenticity and tone of voice in your marketing. So please tune in for that. We'll end the broadcast